I'm about to show you a live look-in of a real deal that was originated by our lending company, Hard Money Bankers, and I'm curious if this is a deal that you would do, or should us as a lending company do this deal? And I'm guessing as I share my screen with you here in a second, so if you're watching this on video, you'll be able to see all the details of it. If it's on audio, I'm going to describe it all, so don't worry, or you can just hop over and watch it on video. But I'm curious if you would do this deal. I think 50% of the people, of the lenders, would probably say, "Absolutely, I definitely do this deal." And I think 50% of the lenders would say, "Run, never do that deal."
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
A little bit of a backstory. So the borrower inherited the property with his sister about a year ago. So they inherited this property and they attempted to renovate the house themselves. All the rehab costs so far have been funded out of pocket by the borrower. And upon closing, $50,000 is going to go to buy out the sister. He funded the construction so far out of pocket. And then his sister wants out. He's going to pay her $15,000 and he's going to take it out. He claims that they only really need $50,000 to finish the property. And the loan proposal is a 6 months prepaid in interest, so he won't have any liability, or he won't have any payments due throughout, because the money's not accruing, the payments aren't accruing. It's actually prepaid, so they're getting net funded out to the lender on the front end. Typically, we don't love doing that, especially because we like to just see borrowers making payments to show that, they're in good standing and they're, everything's up to date. But there is a construction holdback, so obviously we'll be able to take care of that and keep an eye on it. So if you see kind of the terms of the proposed loan, it's a refinance with construction holdback. 15,000 is going to the sister, 40,000 is going to construction. The loan amount's 100,000. The after repair value is 400,000. So it's about a 25% LTV based off the ARV. The as is value is about 225, give or take. So you take a $100,000 loan amount minus the $40,000 in construction holdback, so that's $60,000 exposure on a 225 value. So I mean, you're a really low LTV that way. The borrower's getting $17,000 at closing to continue and start, keep going with the work, plus $40,000 construction holdback. So there'll be $50,000 in total work, total budget. He claims it only needs 50. I'm gonna show you some pictures. It looks like it definitely needs a little bit more. 12-month term, X strategies to sell, credit score 487. So again, ask yourself this question: is this a deal that you should do? Is this a deal you would do? I think it would be 50-50. I think half the lenders would say, yeah, absolutely, low LTV, 25% LTV, can't really lose. If the borrower defaults, it is what it is. Um, you know, Whatever. It's low LTV. I'll roll the dice. I think the other half of the room would probably say 47 credit score. The property's a mess. I don't care what the LTV is. I don't want to mess with this deal. And I'll tell you that, like, we're usually, in the middle on something like that as well. We typically make a business decision if it's a deal that we want to mess with or not. Um, you can see some pictures coming up here right now. Let me move myself out of the way if you're watching this on video. So it's only 1,000 square foot property, no central HVAC. I don't remember if they're installing that, if that was in the scope of work or not. I want to, because I don't know if I see any ducts being run in HVAC, but some of the plumbing and some of the electrical mechanicals are kind of installed. I mean, honestly, the property looks like it's in disarray. Like, they weren't fully kind of had a full game plan, moving from room to room. But yeah, that's it. So I'll kind of tell you what the outcome is in this particular setup. So HMB did decide to close this loan. We closed this loan recently, and I thought it'd be a good case study, because I literally think that if I told you we did this deal, I think a lot of people are like, no way. You always talk about, not lending to less sophisticated borrowers, even if it's a low LTV, it's going to be a headache, not something you want to deal with. I agree. We talk about it all the time, and it's true in most cases. Um, and then I think some people again are going to be like, "Hey, it's a low LTV. What does it matter? You just foreclose on the property. If it's a headache, you run default interest, and let the attorneys do the work and keep it moving. That's okay as well. Um, we feel currently that we kind of have our portfolio has been pretty clean lately. We haven't had a ton of defaults. Uh, we've had multiple conversations with this borrower. I think the borrower's budget of 50,000 is I think it's gonna be tough. I think it's gonna be hard for him to get this done, but he swears that like, "Hey, it's enough. I can get this done. I'm doing a lot of the work, and I'm subbing out some of the other stuff that I attempted to do that didn't love." He knows that until he has up-to-date building permits, I think he might actually have permits in hand now because this did kinda close recently, but it was in the process of it, but no more funds are getting dispersed until he had permits. The one other thing that I didn't necessarily that I forgot to say earlier was like this is actually in a pretty good area. The ARV is 400, and yes, it's a small house, but all the other houses around here are pretty nice. It's a nice homeowner area, and he just kind of happens to have an infill lot that just has an old kind of nasty, crappy house on, and it's, only 1,000 square feet. And if he puts anything decent on it, you know, properties in this area were significantly more than 400,000. And I would guess that he's going to sell for more than 400, but that's just what we were comfortable with the ARV. And one of the big things that you always have to ask yourself is, am I protected at at any point in the loan? So, for instance, our day one exposure is $60,000. We're doing a loan of 100,000 with a $40,000 holdback. Our day one exposure is $60,000. There hasn't ever been a sale in this neighborhood in the last 10 years for under 300,000. Now, yes, this is a smaller one out of that. We think probably 225 is as is, 400 is ARV. I mean, there's also houses that go close to $1 million in this neighborhood to begin with. So again, just because we're at a super low LTV doesn't mean that it's overall a good deal. That's not what I'm indicating. That's not the case. Um, I don't know. I think for some reason we've talked to this borrower multiple times, met the borrower. I understand what he's trying to do. I do think he's gonna have a hard time executing. I really do. I think he's gonna have a hard time executing and being able to do this. But he also knows it's like, hey, you need to get this project moving along quickly and do it the right way and properly. And we're not dispersing any more funds if you don't. And he's got a lot to lose because yes, he inherited the property. So in essence, he got, free equity built in, but he also did all the work so far out of pocket. Plus he's paying his sister $15,000. So there are some good things that have happened. I mean, he's very vested in the project. And I think being vested in the project is important. And mostly when you're vested, when I mean putting cash into the pocket. And I don't know exactly what he put in. I mean, I don't recall exactly what he told me. It's probably less than he probably indicates. But he's got 60, $70,000, but into this thing. He's got a good amount into this already. So he's got a lot to lose. And like I want to do loans for borrowers that in essence have a lot to lose, so they're not going to give up on something. The goal is obviously, to get him, to get him to get the construction done. Hopefully, sell before his first payment's done. He does have a decent job actually that makes him income as well. And one thing I should have stated earlier, but he had gone through a divorce and it banged up his credit pretty bad. So yes, it's still a 487 credit. That's not a good credit score, no doubt. I get that. I'm not sticking up for him in this case. Um, but for some reason, it kind of hit with us and the originator of the loan in my office who was working on this. And it was one of those ones that we were like, hey, should we do this deal? Like, this is really 50-50. And I think it just we just had really good conversations with the borrower. And for some reason, just felt comfortable with them that number one, we felt comfortable with the borrower, even though they don't have a lot on paper going for them. But number two, it is a low LTV deal. And again, I've done lower LTVs deals than this, and the deals have been a disaster. I was sharing a story with on a podcast I was on today, and I was telling a guy about how we did a loan of $200,000 on $1 million property, no payments in 4 years. I mean, obviously, we've been trying to foreclose. They filed bankruptcy multiple times. There was a title defect, had to do a title claim. Then, it went back to foreclosure after we got put under it. Then they filed bankruptcy again. They did this. It's been literally 4 years. Like, do the math of what that $200,000 loan goes to with default interest. There were in this particular case, not to get off subject, but there was, there was blighted. It was a blighted property, so we got assessed with, the tax assessment's $1 million, and then we got assessed taxes at blighted status because it was vacant and not in good condition, and we had to spend $70,000 out of pocket to get the taxes current. So like, just imagine what our payoff is when we started at 200. No investors are making any money on this deal at this point. So, like, it ended up in that deal, and actually, that deal, the borrower had really good credit, and they ended up being significantly less sophisticated than we thought. They had good credit, they just weren't sophisticated. So, good credit doesn't always mean like good quality borrower by any means. And I'm not saying that this borrower in particular is going to be a super high quality borrower either with his credit score. I'm not sticking up for him in that case. Point is, it's case by case. And if you ask yourself, should I do this loan? Think about the pros, think about the cons. I would say, a lot of times I would look at this deal and be like, I don't know if I really want to mess with it. But we were comfortable messing with this particular one, mostly because I do think that it's in a good enough area in the suburbs, in a good spot where I think like we'll be good. Like I do. If this was in the city or an older style property and not as much desirable area, I'd be a little bit more concerned about it. But I think overall the deal will work out. So I ask you, I end this case study with, would you do this deal? Would you do this deal? Comment below. I'm really curious if you would. We ended up doing it. We'll circle back in a few months and let you know how it goes.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.